Have you invested in the mutual fund scheme, or maybe your friends, or maybe your relatives? If the answer to this question is yes, then my next question is, in which scheme did you or did they have invested? Don't know really? Then क्या mutual fund सही है? Hello friends, and I welcome to you all in this video. And in this video, I will be discussing all basics about mutual fund. Those who want to earn a little above FD returns, but simultaneously they are scared to invest directly in stock market. For such a person, it really becomes difficult to understand where he should invest. If you don't know about your risk appetite, that means risk taking capacity, or if you don't know what is your goal, you don't know where you are parking your money, then you should definitely ask such a question that क्या mutual fund सही है to invest? Let us quickly see what are the topics we will going to cover in this video. First, what is mutual fund? Next, what is the pricing of mutual fund? Next, what are the types of mutual fund? Discuss one specific type of mutual fund in detail and precautions and tips. So friends, let's get started. Now let us see what is the definition of mutual fund. Mutual fund is a mechanism for pooling of the resources by issuing units to the investors and investing funds in securities in accordance with the objectives as disclosed in the offer document. And you have understood nothing. So let us take an example to understand the definition. Suppose there is some electricity problem in my house, and if I know how to correct it, I will do on my own. But if I don't know, then I will hire a professional, an electrician who will correct it. Let's take another example. Suppose I have to go from Delhi to Mumbai. I have two options. First, I take my own car and drive to Mumbai if I know how to drive, which way to take, and what rules to follow. So if I know all these things, then I will choose which way to go and I will go on my own. But the option 2 is, if I don't know how to drive or not interested in driving, then I will better hire a professional, that is professional driver, and he will take all the decisions on which way to choose, at what speed to drive, and I will keep all the decisions at his discretion. I will just told him the destination and he will take all the decisions. So that's exactly is the difference between investing directly in stock market and investing through mutual funds. If you invest directly in stock market, then you take all the decisions. You invest at your own discretion. You have an expertise in that. Or maybe no. You do technical analysis, you do fundamental analysis, or a combination, and you invest directly in stock market. But in the second category, you are not bothered to explore things, don't have an expertise, don't have time to analyze. Then you will better hire a professional and he will take all the decisions for you. That's exactly what the mutual fund does. In simple terms, mutual fund manager who takes decision of your money to invest in stock market. So let's see with the help of this picture. There is an investor like us. We are all investors. We are investing funds in the mutual fund. We will give our funds to the fund house, and the fund house will collect the funds from all of us investors, make a pool of that money, and then hire a professional fund manager. And the fund manager will invest that funds, which the pool of funds which the fund house have collected, in the securities, in the stock market, based on the common goals. What may be the common goal or objective? That may be your wealth creation or your capital appreciation. Capital appreciation means difference between sale and purchase price. Different objectives the fund house may be having. So the fund manager invests in the securities based on that objective or goal, and then from that investment it will generate returns and give back that returns back to the investors who have originally invested in that fund. Obviously, retaining some management fees for the professional service, and then giving back the returns to the investors. So let us see one more time how it works. First, the investors like us, we give funds to the mutual fund. Mutual fund pool our money, then appoints a fund manager. Fund manager selects securities based on the goals or objectives, and on that basis it invests in those securities the pool of funds. From that investment it generates returns and then distribute the returns back to the investors who have originally invested the funds. And this pool, as said, is managed by the expert. An expert is fund manager. Each mutual fund has a different investment objective that is set up by the fund manager itself before launching the scheme. And that based on that objective, mutual fund manager picks up the financial securities for investment and also consider the risk return parameters. So now the definition is clearer. That is, the mutual fund is a mechanism for pooling of the resources. Pooling of resources means pooling the funds by issuing units. So as discussed, units means in return of funds, the mutual fund issues units to the investors and then investing funds in securities in accordance with the objectives as disclosed in the offer document. Offer document is scheme information document. Basically, it's all the details about the scheme is mentioned in that document. So it's simply an offer document. Now understood? Mutual fund definition. Simply, you can say it is a vehicle for investing in the portfolio of stocks and bonds. Now, who is the regulator of mutual fund in India? Mutual fund regulator is SEBI, Securities Exchange Board of India, who is also a capital market, securities market regulator. Now, certain question. What is the benefit for mutual fund? Mutual fund investing the funds, from that investment they are getting the returns, they are getting the income, and that may be in the form of interest, dividend or capital gains. Capital gains means difference between sale and purchase price. What does mutual fund does with that income? It distributes that income back to the investors who have originally contributed to the pool of funds. Does mutual fund distribute entire income? The answer is obviously no. Mutual fund is not doing any charity work or social work. They will take out some portion from that income and then distribute the remaining amount back to the investors, and that small portion is called management fees or expense ratio. Typically, management fees is 1% to 3%, 1% or 3% of total funds invested. Now, how is the pricing of mutual fund is done? At what price we purchase the units of mutual fund? We purchase at NAV. NAV is net asset value. Now, what is this NAV? NAV represents the performance of that particular scheme of mutual fund. How does it is calculated? It is calculated as market value or fair value securities plus net current asset. Net current asset is asset minus liability divided by number of units outstanding in that scheme. So as mutual fund invests the money in the securities market, NAV is the market value plus net current asset divided by units as discussed. Market value changes every day, so NAV also changes every day. And NAV is required to be disclosed by mutual fund on a regular basis, daily or weekly. That will be dependent upon the type of scheme. Now let's discuss about the types of mutual fund. And before proceeding to types, let's discuss about the schemes of mutual fund. We have three schemes of mutual fund: open-ended, close-ended, and interval. Open-ended fund scheme is not listed on the stock exchange, and it is available for subscription repurchase on a continuous basis. It's an open-ended means once we purchase the units of that open-ended scheme, if we want to invest further or sell the units, then we have to do with the fund itself. We cannot do on a stock exchange. We cannot buy sell further on a stock exchange. stock exchanges NSE, BSE, National Stock Exchange, Bombay Stock Exchange. And these schemes do not have a fixed maturity period. Next is close-ended fund scheme. And the close-ended scheme is that we have certain maturity period. It is open for subscription, but if we want to buy further or sell it, then we have to go to the stock exchange, because these are listed on the stock exchange. So it's like in companies, it's if companies listed, then the IPO comes and we purchase the shares of the company at IPO, and then if we want to buy further or sell, we do at stock exchange. In the similar fashion, close-ended schemes are like we at the initially when these schemes are issued, so we purchase the units, and if we want to buy further or sell, then we have to do through a stock exchange. These also have a fixed maturity period. Interval fund scheme. Interval fund scheme is where that we have, this is also not listed stock exchange. We have to purchase or sell during that particular pre-decided time period. So the fund scheme will declare the time period. Only in that period we can purchase or sell the scheme, the units of the fund of the scheme. Now let us discuss about the different types of mutual funds depending upon the investment objective. First is equity mutual funds, next debt-oriented mutual fund, balanced fund or hybrid fund, gilt fund, solution-oriented fund, and other mutual funds. So let's discuss one by one. First is equity mutual fund. In this fund, normally major part of the corpus means the total pool of funds that is invested in the equities directly in the stock market. So it is comparatively high risky because of the daily fluctuations in the market price, and it offers different options to investors. Dividend option, capital appreciation, which means that is difference between sale and purchase price, and that investors has a right to choose upon this. Next is debt-oriented mutual fund. So these invest in fixed income security. Fixed income security means you will regularly get some income from that, like bonds, debentures, government security, money market instrument. So it is less risky as compared to equity scheme because they are not directly affected by the regular fluctuations in the equity market. And purpose is to provide the regular and steady income. Next is the balanced fund or hybrid fund. It's a balance, name suggests, debt plus equity. So in this, it is means some portion of the funds is invested in equities, some portion invested in the debt instrument. Proportion can be any, and this is also affected by the fluctuations but less affected because not whole entire funds or major portion is invested in equity. There will be a proportion which is invested in equity, so less affected but affected by the fluctuations in the share price. Next is gilt fund. So these funds invest exclusively in government securities and 100% safe, no default risk because invested in the government securities, so guaranteed by the government. Next we have solution oriented fund. For example, your children education, children marriage, retirement fund. Means you want a solution after some time for which you have invested your funds, and whenever the time comes you will redeem, means you will take out the money from the fund. So that is solution for meeting your solution. So solution oriented fund. Next is other mutual funds. For example, index funds. Index means Nifty and Sensex. Nifty represent 50 best stocks and Sensex represent 30 best stocks. So index funds will replicate that portfolio of that index. Now let's discuss about the specific type of mutual fund, that is a liquid fund. It's a debt-oriented mutual fund. In this, the funds are invested in short-term instruments, which have a maturity period of up to 91 days, 3 months. And invested funds in treasury bills, certificate of deposit, commercial paper, interbank call money, government securities. So these may be new to you, but you simply understood short-term instrument. Return fluctuate but less fluctuate as compared to other. And major purpose is you have a liquidity. So major aim is to liquidity, provide liquidity. Now, for whom the liquid funds are useful? For those who have surplus money and they want to invest for short term but don't know where to invest, when to invest. How much return can we get from these funds? Up to 7%. That will be exceeding your saving account interest and maybe more than FD returns. One question is, if I invest in these funds and after 10 days I want my money back to invest in other area or want money for other purpose, then will I get my money back immediately? The answer to this question is yes. Mostly you will get your money back within 2 days. Now, precautions and tip. Precautions means certain things you need to keep in mind while investing in the mutual fund. First is entry load. Entry load means whenever you invest in the mutual fund, whenever the funds are invested, some portion is deducted and remaining portion is invested in the mutual. So that is entry load. Entry load is generally zero. Exit load. Exit load is similar to entry load, but it's not similar to management fees, management expense. Exit load means whenever you redeem your funds, some portion is deducted and remaining amount is given to you. It is also zero for majority funds, but in some funds, if you exit within 7 days of investing, then there may be an exit load. Next is lock-in period. Lock-in period means for some period you cannot redeem your funds, you cannot sell. So that is a lock-in period. This is no for any scheme. Next is risk and reward. There must be, everyone sees to mutual fund like they want to take less risk and they want to earn more. It's not like that. Is there zero risk involved in mutual fund? Answer is definitely no. As the mutual fund tagline also says the same thing. Mutual fund investments are subject to market risk. Please read the offer document carefully before investing. So its tagline also saying the same thing, that the risk is there. You have to consider the risk. It's not risk free. But liquid funds are definitely in the low risk category of mutual fund. Tip I want to give here, that is please don't invest all your money in one investment avenue. Keep diversified portfolio. There is a saying that don't keep all your eggs in one basket, because if the basket is dropped, basket falls, then all your eggs will be broken. So keep diversified portfolio, because diversification reduces the risk. If there is a profit in one and there is a loss in another, then it will be offsetted. Loss will be offset with the profit. Please do proper asset allocation. If you have any questions, you can post your question in the comment section of this video and I will be happy to answer. Thank you friends for watching. If you liked the video, please like, share, and may consider sharing this video. You may consider subscribing to the channel. Thank you. Jai Hind and have a nice day.